हेलो फ्रेंड्स, वेलकम टू माय चैनल एमएन कोचिंग सेंटर। तो आज मैं एक्सप्लेन करने जा रहा हूँ आपका सीए अकाउंटेंट्स का सेकंड चैप्टर अकाउंटिंग कॉन्सेप्ट्स एंड कन्वेंशन। तो इसमें आप लेवल क्या पढ़ेंगे, मतलब ऑब्जेक्टिव्स डे पढ़ेंगे अकाउंटेंट्स के कंसेप्ट्स के बारे में, अकाउंटिंग कॉन्सेप्ट्स एंड कन्वर्जेशन के बारे में। उसके बाद आप मीनिंग जानेंगे एंड फीचर्स ऑफ अकाउंटिंग प्रिंसिपल्स, और उसके बाद आप जानेंगे काइंड्स ऑफ अकाउंटिंग प्रिंसिपल्स, अकाउंटिंग कॉन्सेप्ट्स जानेंगे। उसके बाद कॉन्सेप्शन, समरी और कीवर्ड्स। तो पहला ऑब्जेक्ट, पहला टॉपिक। तो आफ्टर स्टडिंग दिस लेसन यू शुड बी एबल टू appreciate the need for a conception framework of accounting, understanding and describing the general aspects of accounting principles GAAP, and you should know the importance of and advantage of uniformity in the accounting policies and practice. So these were the objects. After that, let us come to the introduction of the accounting. So accounting is often called, it is the language of the business, because for the purpose of accounting it is like a communication or report or the result of the business operation, and it has various aspects, various users of the accounting information are there. And in fact today accounting statements or report are needed by various groups like shareholders, creditors, potential investors, many other people. And in view of the unity of the accounting reports to various interested parties, if view of the unity of all accounting reports to the various interest parties, it becomes imperative to make these languages capable for commonly understood by all. These language accounting will be understood commonly by all. Accounting could become an intelligible and commonly understood language if it has based on the central concepts of accounting principles. Hence, we must familiarly learn about the accounting principle and what all the properties it has. So, meaning and features of accounting principle. So, for searching the goals of the accounting profession and for expanding knowledge in this field, you should have a logical and useful set of principles and procedures that should be developed. So let us know that while driving our vehicles, let us follow a standard traffic rules we will follow when we drive our vehicles, as you all know. Without adhering traffic rules, there would be much chaos on the road. There will be much problems on the road while driving. Similarly, some principles apply to the accounting. Thus, without this, the accounting will be not easy for you. Thus, the accounting profession cannot reach its goal. In the absence of these rules or guides, it cannot reach the goal what it has, what it should bring to a goal it should make to reach the what goal to a goal where they should reach the company. It will not reach without accounting principles. So it is very much important. So the rules and principles of accounting, or they are referred as the conceptual framework of the accounting. So accounting of a chartered accounts, as they are the body of doctrines commonly associated, they are associated with the theory and procedure of accounting. They are very much similar to know. So therefore they are serving as an explanation of current practices. They are serving as, they are giving explanation of the current practices and a guide for the selection of the convention or the procedure what they have to do. This is for selection of that, where alternative exist, where another people also exist. So rules governing the formation of accounting also, and the principles derived from them have, they have also arisen. They are arisen from, they are arisen where from common experiences, historical precedent statements by individual and professional bodies, and regulation of the government agency. From these things, the common rules, principles of the accounting we have found or originated. So accounting. So according to the person whose name is Hendrickson, in 1997, accounting theory, he has defined it locally as, define it as broad principles that as accounting has. First is providing a logical reasoning in the form of a set of broad principles, providing a general frame of reference by which accounting practice can be evaluated. So we should provide a general frame of reference for reference by which accounting practice we can make it easily evaluate, we can evaluate it easily. And the second rule principle is guide the development of new practices and procedure. Theory may also be used to explain existing practices to obtain a better understanding of them. But the most important goal of accounting theory should be to provide coherent set of logical principles that form the general frame of reference. And also they also say that you have to develop and make new sound accounting practices, make new accounting practices. You should develop it and you should prepare it. And another, the American Institute of Certified Public Accounts, AICPA we can say them as, they has also advocated some of the principles which which says the principle is rule of action. So it discusses the general aspects of accounting principles, like the general aspects are like financial statements or the product of the process in which a large volume of data about aspects of the economic activities of an enterprise out in a conformly we should have with general acceptly we should accept it by accounting principle only about the financial statement. And also this information should be the information that you get about the financial statement should be recorded. And also what information should be disclosed or finished, or how it should be disclosed, and when financial statement should be prepared. And the generally accepted principles and standards provide a common financial language for all the accountant who will study this, to enable informed users to read and interpret financial statements. So these all they should write it like a easily that all the users or the head of that company or the manager, whoever studies it, he can generally read it and he can generally understand it like that easily. They should have written it. And generally accepted accounting principles encompasses the conventions, new conventions, rules and procedures necessary to define the accepted accounting principle. There should be rules, procedure to practice at a particular time. For that accepted accounting we have to practice it at a particular time. Generally accepted account principles include, it does not only has a guidelines of general but also general application, but also it is detailed practice and procedures. It has statements of the accounting principles. And also broad number 4 tells us about the basic concepts and accounting principles underlying financial statement of the business enterprise. Other thing it tells us about. Next, according to the dictionary of accounting prepared by the professor whose name is P.N. Aprol, accounting standards the accounting standard, it refers to only to accounting rulers and the procedures. Such bodies as the account, we call it as accounting standard committee, we can call it as ASC of a particular country. So particular country has its own accounting standard committee. Thus we may define accounting principles as those rules of the action or conduct which are adopted by the universally while recording accounting transaction. Accounting principles are man-made. They are made by the man. Accounting principle, they are accepted because they are believed to be useful for the man, so that's why they are taken. And the general acceptance of accounting principles depends on its following three basic things, or that are the usefulness, objectiveness and feasibility. See, on these things the accounting principles are based. So a principle is useful to the extent that it results in, for the accounting, it results in a meaningful or relevant. It gives some information for those who need to know about that certain business or about the accounting. In other words, accounting rules does not increase the utility of the records to the its readers and is not expected as an accounting principle, but a principle is objective to the extent that it information is not influenced by the personal basis of the judgment of those who are furnished it, but according accounting principle is said to be objective when it is solidly supported by the facts and accounting principles. Principle so a principle is feasible when it can be implemented without undue difficulties or cost. Although these three features are generally found in accounting principles, an optimum balance of three is struck in some cases for adopting some particular rules as an accounting principles. Let us take an example like the principle of making the provision for doubtful debts is found on feasibility and usefulness, though it is less objective, but this is because of the fact that such provisions they are not supported by any outside evidence, they are not supported from the outside. Next, kinds of accounting principles. What are the different kinds of accounting principles? Let us know about the next topic. So in dealing with the framework of accounting theory, we are confirmed number of words and terms have been used by different authors to express and explain the ideas of them to the accounting principles, and the various terms used for describing the basic idea of accounting principles are like concepts, postulates, propositions, assumptions, underlying principles, fundamental conventions, doctrine, rules, axioms, etc. Many other things they are persons or the scientist or account they have used for growth of accounting, but accounting profession he have served to give them loose and overlapping meanings, loss and overlapping new meanings, and one author may describe the same idea or notation as a concept and another as like a convention they may explain it as so, and still another or postulates may they may say it as it is the postulate of accounting. So for example, the separate business entity idea described by has been described by one author. He said it as concept. By another author, he says it, the business identity is a convention. So it is better for use not to waste our time to discuss about the meaning of the generic terms, as the wide diversity in these can only serve it confuse for our learning. So let us go to our next topic. So we do feel, however, that some of these terms ideas have a better claim to be called. Some of them are called as concepts while the rest should be called as conventions. So the term concept is used for content to accounting postulates practice in other statement of that business enterprise. And the reason why some of these terms should be called as concept is that they are basically assumption and have a direct bearing on the quality of the financial accounting information, and the term convention is used to signify the customs and traditions as a guide to them. And also the preparation of accounting statements. The following are the important accounting concepts and conventions. The accounting concepts, they are the separate business entity concepts, money measurement concepts, dual accept concept, accounting period concept, cost concept, the matching concept, the accrual concept, the realization concepts. Next, accounting convention is convention of materiality, convention of conservatism, convention of consistency. So let us know about accounting concepts, the different types that we saw about the seven 8 types of the accounting concepts. Let us know about the accounting concepts step by step. So the first one we saw is the separate business entity concept. So in this concepts accounting, we make the distinction between the business and the owner. The distinction will be separate, and then all the books of the account recorded by the day-to-day financial transaction from the viewpoint of the business rather than from that of the owner. The proper proprietor of considered as they are considered as a creditor to the extent of the capital brought in the business by him. For instance, money from the owner. He is not an investor, he is a owner. Like that it will treat, and it will be shown as the liability in the books of the accounting. Similarly, if an owner is a owner has a shop where to the take cash from the cash box for meeting a certain personal expenditure, the accounts would show that cash has been reduced even though it does not make any difference to the owner himself. They may have to show it as reduced. Thus, in recording a transaction, the important question is how does the transaction it may affect the transaction may affect the business. For example, let us take another example, like if the owner puts cash into the business and he has a claim against the business for capital that was brought in. So in so far as a limited company is concerned, this distinction can be easily maintained because a company has a legal entity like a natural person. It can engage itself in economic activities for buying, selling, producing, lending, borrowing, consuming of goods and services. It can legally make it it is like their work. However, it is difficult to show that these distinction in the case of the sole proprietorship and partnership. It is difficult to show. Nevertheless, accounting still maintains separation of the business and the owner, and it may be noted that it is only for treated as the separate from the owner. So though law does not make such distinction, there is no law for make such distinction, but in fact the business entity concept is applied to make it possible to the owners and assets and the performance of their business and performance of those who manage the enterprise. The managers are responsible for the proper use of the funds supplied by the owners, banks, or the others from whom they have taken. It is important to send the money that they have taken after the get the money profit or they get. Next, the second thing we learned in accounting concepts is money measurement concept. So in accounting, only those business transactions are recorded which can be expressed in the terms of we can expect it expressed in terms of money. In other words, a fact or transaction or happening which cannot be expressed in terms of money is not recorded in the accounting books, as money is accepted not only as a medium of exchange. We cannot tell it as well just medium of exchange, but also a store of value. It is very important for advantage since a number of assets and equities which are otherwise different can be we can measure it and express it in the terms of a common denominator. So we must realize that this concept imposes two serious limitations. First is there are several facts which though very important to the business and cannot be recorded in the books of the accounts because they cannot be expressed in the terms of money. Like example, general health condition of the managing director of the company, working condition in which the workers has to work, and the sale policy pursued by the enterprise, quality of the product introduced by the enterprise, stable or constant value of rupee. So taking this assumption means that the changes in the money value in future dates are conveniently ignored. For example, let us take the piece of land purchased in 1990 for 2 lakh and another bought for the same account 1998 recorded the same price, although the first purchase in 1990 may be worth 2 times higher than the value of the 2 times higher than the 2 lakh record, and we record it in the book because of rise in the land price. In fact, most of the accounts know fully well that purchasing power of rupee does change, but very few recognize this fact. Purchasing power of rupee does change, but very few people knows or recognizes this fact in the accounting books and make allowance for changing the price level very well. Next, dual aspect concept. So financial accounting records all the transaction and events involve financial element. Each of such transactions requires two aspects to be recorded. The recognition of these two aspects of every transaction, we can know it as dual aspect analysis. According to this concept, every business transaction has dual effect. Like let us take an example. If a firm has goods of rupees 5,000 and this transaction involves two aspects, one aspect is a delivery of goods and the other aspect is the immediate receipt of cash what we get. Next, in fact, the debited always, it will be equal to the total amount that we have credited. Like that only double entity book works. And it follows from dual aspect concept only, it follows the double entry book or entry book. So that is so that at any point of the owner equity and liability for the accounts entity will be equal to the assets and owned by the entity, and the following things are the qualities like assets is equal to liability plus owner equality, owner equity is equal to assets minus liability, like this. So the above relationship here, you know about the accounting equation, that is the owner equity denotes the resource supplied to the owners of the entity, while the terms of liability denotes the claim outside the parties such as creditors and debenture holders bank against the assets of the business, um, are equal to the total liabilities plus one's capital, because all the assets of the business are claimed by either owners or outsiders. Next, going concern concept. So accounting assumes that the business entity will continue to operate for a long time in the future unless there is a good evidence to the contrary, and the enterprise is viewed as a going concern. You should have a concern, and that is continuing in operations what work you do at least in the foreseeable future. In other particular business, the ventures in the words, they table future. Because of this assumption, the accountant, while valuing the assets, does not take into account forced sale value of them, the forced sale value. In fact, the assumption that that the business is not expected to be liquidated in the foreseeable future, that it will be not liquidated, establishes the basics basis for many of the valuation and allocation in accounting. And for example, the accountant charges depreciation on fixed assets, and it is this assumption which underlies the decision of investors to commit capital to enterprise. Only on the basis of these assumptions, accounting process can remain stable and achieve the objectives of the company, and also correctly reporting and recording on the capital invested, the efficiency of the management, and the position of the enterprise as an it is like a going concern. And also, however, if the accounting has good reason to believe that the business or some part of it is going to be liquidated, or that is will be cease to operate, then the resources could be reported at their current values. And if this concept is not followed, international accounting standard requires the disclosure of the fact for the financial statement for the reason why they are not done. Next, accounting period concept. So this concept requires that the life of the business should be divided into appropriate segments for studying the financial results that we shown by the enterprise after each segment. Although the results of the assets have been sold off and liabilities have been paid off, and the knowledge of the results periodically is also very much necessary. Those who are interested in the operating the results of the business or business necessary, those who are interested in the operating results of business obviously cannot wait till the end of it. The requirements of these parties are the force the businessmen to stop and see back how things are going on, whether it is going on or not, and thus the accountant must report for the changes that are needed for the wealth of the firm of in the short time, what the changes they need, so that they may get very good wealth in the growth of the company. And a year is the most common interval on account of privilege, practice, tradition, and government requirements. What all they need practices government requires, they should finish it. And some firms adopt financial year of the government, some firms take, and some other work on the calendar years they work. Although a 12-month period is adopted for their external reporting, what all they require the reports, and a shorter span of interval in a 1 month or 3 month is applied for their internal reporting purpose. For all the internal reports what they all need for that purpose, a short time 1 to 3 months they will take for their purpose of what all they have done in their internal reporting purpose. For that they will take the short 2 to 3 months time. And next, this concept they possess for the process of allocation of a long term cost. For allocation of the long term cost, this process they always find, and all the revenues and all the costs related to the year in any accounting period. This holds very much good for the business. The any accounting period, they should all the revenues and all the costs related to that year in the operations, they have to be taken into the account. We should take it all the cost, revenue, all the revenues and the cost. And while matching the earnings and the cost of the earnings in the accounting period, while checking the accounts, they also holds a very much good, they also holds a very good information, like mm, they also holds a very good information. So a cost concept. So the term assets denotes the resource like land, buildings, materials, these resources that are owned by a business for doing their business works, and the money values that are assigned to these assets are derived as the cost concept. And according to this topic, an asset is ordinarily entered in the accounting records at a price paid to take it, the price that company has paid to take that product, or that amount only they have put it, like 5 lakh they have put it, means they have given and they have took that product, then 5 lakh only they will write in that account. And even if the market value at that time is rupees 6 lakh, they will also still write the value of how much they have given them the money and how much they have took the product, for how much money they have took the product. And the asset shown in the financial statement is not that much necessary that indicates the present market value of that product. It is not that much necessary, but the term that is the book value is used to show the amount in the accounting records, how much amount we have to show in that accounting records. Next is the cost concept. It does not mean that all assets remain on the accounting records only. All assets should not remain in the accounting records at their original cost for all the times it comes, the product it comes. All time it is not necessary that it should be at same cost. Sometimes it may decrease, sometimes it may increase. So there will be going on changes in that products. So the asset may systematically be reduced its value by charging depreciation. They can systematically reduce the product value, which will be discussed in the detail about the next in other lessons. Next, depreciation has the effect of many effects of reducing the profit of their each period. And also the prime purpose of depreciation is to allocate the cost of an asset, how much cost the asset is, to allocate it. It is useful for life and not to adjust its cost. It is not useful for to adjust the cost of the product. However, a balance sheet is based on this concept can be very misleading, as it shows assets at cost even when these are wide difference between their cost and market value. Despite these limitations, you will find that the cost concept meets all three basic norms of relevance. The norms of relevance, objective and feasibility. Next is the matching concept. So this concept, as you know, it is based on the accounting period concept. In really, we match revenue and expenses during the accounting period, how much revenue we have got, how much expenditure we have done for that. And matching is entire process of perioding what are earning measures, often described in the process of matching expenses with some revenues. In other words, we can say that matching revenues or income made by the enterprise during a period can be measured only the revenue what he had got. Then by seeing the revenue only, we can say this company had got this much income during that period. During a period, revenue they have earned, like that only we'll compare that revenue what we have earned to the expenditure, how much we have spent, so that we may know how much income that company has got. And next is, broadly speaking, revenue is total amount that we realized from a sale of goods. We got amount from the sale of goods or provision of service, together with earning for by the interest we got, dividend and other items we have got income. This we can write. Next, expenses or cost incurred, and in connection with the earning of revenue, cost incurred do not become expenditure. So cost incurred what we have got, it does not become an expenditure until the goods or service in question or they may be changed, or cost is not synonyms with expenses, since the expense is sacrifice made. So resource consumed in relation to revenue and during the account period. So only costs that have expired during the an accounting period, or they are considered as expense. Hmm? ಇಲ್ಲಿ ಕಟ್ಟಾಗಿದೆ ನೋಡಿ, ಇದು ನನ್ನ ಬ್ರಷ್. ನಿಮ್ದು ಅದೇನಾ? ತಗೊಳ್ಳಿ, ಇಲ್ಲಿ ಕಟ್ಟಾಗಿ ನೋಡಿ, ಕಿತ್ಕೊಂಡ್ಬಂದಿದೆ ಸ್ವಲ್ಪ.
ಬೇಡ ಈಗ ಇರಲಿ, ಆಮೇಲೆ ಮತ್ತೆ ಗೊತ್ತಾಗಲ್ಲ ಬಿಡಿ. ಅಲ್ಲೇ ಗೊತ್ತಾಗುತ್ತಾ ಇಲ್ಲ, ಬ್ಲೂ ಕಲರ್ ಇದೆ ನೋಡಿ ನಂದು ಮೇಲೆ.
So let us take an example. If a commission is paid for in January 2002 for a service that enjoyed in November 2001, it has taken, and that commission should be taken as the cost of services for, and they should be written in the date of November when they have took in the date of November and that year. And on account of concept, adjustments are made for the all prepaid expenses what we have done for expenses for that outstanding expenses, accrued income, etc. While preparing the report of that year, we will add this also. Next, accrual concept. So it is generally accepted in accounting that the basis of a reporting income is like accrual. Means accrual concept makes a distinction between the receipt of cash and the right to receive it. Receipt of cash what we have made, and what is the right to receive it, and the payment of cash how we are doing, and the legal obligation to pay it, what are the legal obligation we are going to pay it. And this concept provide as a guideline to the accountant to show how he should treat the cash receipts and the receipts related thereto. So accrual principles tries to evaluate every transaction in terms of its impact on the owner's equality, how it impacts on the owner's equity, and the essence of the accrual accrual concept is that net income arises from the event that changes the owner's equity, how much the net amount we get it, net income. It may changes the value of that company, and also it may help that company to grow, and the owners may also get more money. So therefore these are not necessarily the same as change in the cash position of the business. So thus it helps in proper measurement of income. It may help for proper measurement of income. So realization concept. So realization is technically understood as it is like the process of non-cash resources and rights into money. They are the rights into money and non-cash resources. As accounting principle, it is used for identifying the precisely the amount of revenue to be recognized and the amount of expense to be matched to such revenue for the purpose of the measurement how much, for seeing the measurement how much income that company has got. According to realization concept, revenue is recognized when revenue is taken when the sale is happened. On when the day sale is happened, that day only the accountant should write that this much revenue we have got. And sale is considered to be made at the point when the property in goods passes to the buyers and he becomes legally able to pay. So when the goods goes to the buyer and he pays for that goods and he take that goods, at that time it becomes the right to write there in the account that the goods has gone by and the expenditure, income, and how much revenue we have got, that all. And this implies that revenue is generally realized when goods are delivered or services, or revenues we should consider when goods are delivered to the buyer or the customer who want that. And the rationale is that deliver validity a claim against the customer, so there may be deliver validity should be there. And however, in case a long run construction contracts, revenue is often recognized on the basis of proportionate or partial completion method. So a long term, see, construction takes 1 year, so they will make partial, this much money I will use, this much for each steps. When you finish the construction of this much, if it finish, I will give this much. He will sell in that contract what they have made with that construction company. Similarly, in the case of long-term installments sales contracts, revenue is regarded as realized only in proportional to the actual cash collection. In long-term revenues or long-term run of installment of sales contract, so the revenue takes as the cash that are they collected from them. And in fact both these cases are the exceptions both are exception to the notation that exchange is needed to justify the realization of revenue. Exception is needed, or exception is needed sometimes for the exchange needs to justify the realization of the revenue. They need some exceptions. Next, accounting conventions. So convention of morality is the first topic in accounting of convention. So materiality concept states that items of small significance need not be given strict theoretically correct treatment. So small products does not need more treatment or changes. In fact, there are many events in business which are insignificant, which are not significant in nature, and the cost of recording and showing the financial statements in such events will not be well justified by utilizing the to derive that information, to say that information. For example, let us take an example. So let us take an example. A ordinary calculator cost rupees 100, lost 100 may last for 10 years. For 10 years it converted 100. However, the efforts that involved for allocating its cost over the 10-year period is not worth to the benefits that can be derived from their operations. It is not benefiting for them, and the cost incurred on calculator may be treated as the expense. How much they expenses they do, that much only they will earn. That's all. Similarly, when a statement of outstanding debtor is prepared for sending a top management, figures may be rounded to the nearest 10 or 100, like that. This much for 10%, 100% we have got profit, like that they may be rounded. And this convention will unnecessarily overburden an accountant. It may give burden to the accountant while calculating it, and with more details. In case he is unable to find the objective distinctions between the material and immaterial events, he cannot find whether it is a material event or immaterial event. And it should be noted that an item material for one party may be immaterial for another party. So immaterial, if we taken for one party, it may be immaterial for the another, for another group or another company that you are sending, it may be immaterial for them. So actually there are no hard and fast rules to draw the line between the material and immaterial events, and hence it is a matter of judgment and common sense. It is a matter of common sense. Despite these the limitations, it is necessary to disclose all materials information to make the financial statements clear for the managers and the owners of that business in spite of all these problems. Next is convention of conservatism. So the concept requires that accountant must follow the policy of playing safe while recording the business transaction and events. That is why the accountant follow the rules of anticipate no profit but provide for all possible losses. So it provides all possible losses in that book. While recording the business events, these rules means that an accountant should record lowest possible value for assets and revenue. What are the lowest possible values he got in that transactions, he should write that, and the highest possible value for the liabilities and expenses also should write. According to this concept, revenue or gains should be recognized only when they are realized in the form of cash or assets. When they are in the form of cash or assets, that time only we can tell it as gain or revenue, and the ultimate cash realization of which can be assessed with reasonable certainty. So further provision must be made for all known liabilities, expenses and losses. For provision should be made, and probable losses regarding all contingencies should be, they all should be they all should be also provided for valuing the stocks and in trade at market price or cost price, whichever is less. You should write whether it is for cost price or market price, or where it is the price is less. And making the provision for doubtful debtors that are doubtful, actually they are the bad debits. Adopting written down value method of depreciation as against straight line method. Down value should be right against the straight line method. Not providing for discounts on creditors. No discounts on creditors should be written, but providing the discounts on debitors should be written, or some of the examples of this application of the convention of conservatism. Next is the principles of conservatism may also be inevitable criticism if not applied consciously. Let us take an example. So when the accountant creates a secret reserves by creating excess provision for bad and doubtful debits, if he makes bad and doubtful debits more in his book, and depreciation may also if we increase, etc., the financial statement do not present a true or fair view of the state of affairs. So they may not get true or correct view how is their company, whether it is growing or not. And also American Institute of Certified Public Accounts has also said that these concepts needs to be applied with much more caution. It should be taken very good caution to apply well in this concept. Applying the conservatism concept, this may result in misrepresentation. They may sometimes miss while applying this concept. The representation showing they may sometimes miss. So that's why they should be very careful. Why you should be very careful while doing the conservatism. Next, convention of consistency. So the conversation of consistency requires that once a firm is decided to on certain accounting policies and methods, once their company has decided and has used these for sometimes they have used these firms, and it should continue to follow the same method or procedure for all the events of and transaction they have done in that year, unless it has sound reason to do otherwise. Unless they have some reason to change it, till that they have to continue what things they are doing. And in other words, accounting practice should be remained unchanged. It should be remain unchanged from one period to another. There should be no changes in that. And for example, if a depreciation is charged on fixed assets according to the straight line method, this method should be followed year after year. According to this, it should be followed year after year. Analogously, if stock is valued at cost of market price, whatever if it is less, and this principle should be applied in each subsequent year. Every year it should be applied. However, this principle does not forbid introduction of improved accounting techniques. It does not have introduction about improved accounting techniques, but if for valid reason, if the company makes any departure from the method so far in use, they take this method or they may change for any reason, then the effect of the change must be clearly given the statement. For the financial statement, they should give a clear statement reason why they are changing in that year, why they are changing. They should give the reason for the financial statement, and the application of the principle of consistency is necessary for the company. They should say why they are changing that accounting statement, what all the wrong topics they have in that. They should give the reason for that accounting statement. Next is purpose of comparison of this is one should draw valid conclusion from the comparison that they had got from the financial statement on that year with that of the other year. Also you should take the comparison, but the inconsistency in the application of accounting methods or sometimes rightly reported. Next is accounting standards. So the accounting concepts and conventions that we have discussed in till now, or the page foregoing pages, or the some of the elements in the theory of the accounting. These principles, however, they are permitted a variety of alternative practices that are coexisting now. On account of these, the financial results of different companies cannot be compared. We cannot compare the financial results of different company with our company and evaluate unless full information is available about the accounting methods which have been used. So unless we cannot evaluate unless we have all the full information that are available about the accounting methods. Unless we cannot evaluate it again. And the lack of uniformity among accounting practice have made it difficult to compare the financial results of different companies. So there are many unity between the accounting practices, so it has made difficult for taking the comparing their company with the different companies. So it means that there should be not be too much discretion to companies. There should be not too much discretion between the companies and their accountants to present financial information in the way they like. So they may will not tell what they like with the financial statement of that company is there. They cannot say our company is growing, our company is falling like that. They have some accounting here. You learn these all policy, the accounting concepts and convention also they should use. Let us say some of the standard accounting standards that are needed to do or the to provide a basic frameworks for preparing financial statements. They should provide a basic framework so that they to be informed followed by all business enterprises. All business enterprises to follow them, a basic framework should be provided. And also they should make the financial statement of one firm. We can compare it with the financial statement of the another period of the same firm. So if the one we see take this year 2021, how much they have in the end of this year, how much their company has earned, we should compare it with the last year. Like that they should make, and may we have to make the financial statement creditable and reliable, and we have to also make create general sense of confidence among the outside users, also users of the financial statement. We should make a general sense of confidence for them in this concept. Unless there are some reasonable appropriate standards, sorry, so there are some of the purpose of the individual investors nor that of the nation as whole can be served for the nation in order in the growth of national economy. So in order to harmonize accounting policies and to evolve the standards that are needed in the USA was felt with the establishment of Securities and Exchange Commission (SEC) 1993-1957, a research-oriented organization called Accounting Principle (APB) Accounting Principles Board (APB) was formed to spell out the fundamental accounting principles. To make the fundamental accounting principles, they were made, and after this, the Financial Accounting Standard Board was formed in 1973 in order to their financial accounting in fundamentals. And FSC was formed in 1973 in USA, and at this international level it is needed they are needed for standardization was felt, and therefore the international level they are needed for standardization was. So it was formed in 1973, and in USA at the international level, the needed for standardization was felt, and therefore the MOD International Congress of Accounts was formed, organized in Sydney and Australia in 1972, so that to ensure that they have desired level of uniformity in accounting practice. And keeping this in the view, International Accounting Standard Committee (IASC) was formed in the entrusted with the responsibility so that to formulating the international standards of the accountancy. In order to harmonize varying accounting policies and practices, the Institute of Chartered Accountants of India (IACAI) formed the Accounting Standard Boards (ASB) in April 1977, and ESP includes the representatives from the industries there and the government in India, and the main function of the ESP is to formulate some of the accounting standard. And this board of the Institute of Chartered Accountants of India has so far they have calculated around 27 furnished, and regarding the position of the accounting standards in India, it has been stated that the standards have been developed without the establishment of essential theoretical framework they does not have, and as a result accounting establishing the essential theoretical framework, as a result accounting standards lack directions and confidence. And these types of limitations also existed in the UK and USA, but it has not remediated. It was remediated. They solved the problem long back, but here still the problem continues. Hence there is an emergent and need to make the attempt to develop a conceptual framework for accounting in India, and also revise suitable the Indian accountancy standard to reduce the number of alternative treatments for accounting. So okay friends, this was your chapter, the accounting concepts and conventions. So like the video, comment on my video and subscribe my channel coaching center for more video. I will see you in my next video. Till then, take care, have a nice day, bye my dear friends.